Welcome back to Talk Tickers. Today is Tuesday, January 20th, 2026, and we are doing a deep dive into the latest numbers from America's builder, D.R. Horton. And let me tell you, if you were watching the ticker tape this morning, you probably got whiplash.
It was a classic head fake, wasn't it?
Seriously. The stock pops, about 4% in the pre-market? Everyone's celebrating a headline beat, champagne corks popping, and then, boom, it reverses. Trades down about 4% as the session wears on. That is a massive swing for a company this size. You don't usually see that kind of volatility on a blue chip builder unless something's really nuanced in the numbers.
It's huge. But when you actually, peel back the layers of this earnings report, that reaction makes perfect sense. This is a story of quantity versus quality.
Okay.
On paper, the volume engine, the machine that sells houses, is roaring. I mean, it's practically overheating. It's running so fast. But under the hood, the cost to keep that engine running is getting significantly more expensive.
That is exactly what we're here to unpack. We're going to look at why a double beat on the top and bottom lines resulted in a sell-off. And spoiler alert for everyone listening, the devil is entirely in the guidance and a specific line item called gross margin.
That's where the real story is today. It's the difference between selling a lot of widgets and, actually making money on the widgets you sell.
But before we get into the weeds, and we are going deep into the weeds today, let's set the table with the headline numbers. D.R. Horton reported their Q1 fiscal year 2026 results this morning. Give us a snapshot.
So on the surface, it looks like a solid win. GAAP earnings per share came in at $2.03. The street was expecting $1.93, so that's a 5.2% beat. You take that any day of the week.
Yeah, any day.
Revenue also came in strong at $6.89 billion, beating the consensus of roughly $6.6 billion.
Okay, so they beat on earnings, they beat on revenue. Those are the two big ones. But I noticed something interesting in the year-over-year comparison. Despite the beat against expectations, revenue is actually down compared to last year, right?
Correct. Revenue is down about 9.6%, but you have to be careful with that number because it's a lagging indicator. Here's the number that really matters for a home builder, specifically for gauging future health. Net sales orders.
That's the forward-looking stuff.
Exactly. Net sales orders were up 3% year over year to 18,300 homes. In an environment where affordability is crunched and interest rates are still, volatile, growing your order book by 3% is impressive.
It is.
They closed over 17,800 homes this quarter. So the immediate takeaway is that the machine works. They are moving units.
They definitely are. And their cash flow is still massive. Operating cash flow is $854 million. So if you're just skimming the press release, or maybe you just saw the headline on your phone, you think, great quarter, stock should go up. But the market hated it by lunchtime. Why?
Because the market stopped reading the headlines and started reading the fine print on profitability. This brings us to the core of today's analysis, the margin story.
Let's unpack this, because there was a specific detail in the gross margin number, the profit they make on each house sold, that I think caught a lot of people off guard. They reported a home sales gross margin of 20.4%. That sounds decent. I mean, for a volume builder, 20% is usually the target floor.
It sounds decent, and it was actually up 40 basis points from the previous quarter. For context, a basis point is 1/100%, so a 0.40% increase. However, management was very transparent that this number was, let's call it, optically enhanced.
Enhanced how? Is this creative accounting?
No, nothing nefarious, but it was lucky. They had a warranty cost recovery. Basically, they won a legal settlement regarding some construction issues down in the San Antonio market. That settlement injected a one-time cash benefit equivalent to 40 basis points directly into the margin line.
Ah, okay. So that's not operational brilliance. That's a lawyer winning a case.
Yeah.
If you strip out that one-time legal win, what was the real margin?
It was flat at 20.0%, and that's what traders call a dirty beat. The headline margin looked improved, but the underlying operational margin was stagnant. But honestly, that's not even why the stock dropped. The stock dropped because of what they said is coming next.
The guidance.
Precisely. Management guided Q2 gross margins down to a range of 19.0% to 19.5%.
That is a significant drop. We're talking about dipping below that psychological 20% line. For a company like D.R. Horton, breaking below 20% usually sets off alarm bells. It signals that pricing power is eroding.
It does. It implies sequential compression. I mean, margins are getting tighter and tighter. And when you ask why, the answer is really just one word: incentives.
Right. And this is where it gets fascinating. For anyone trying to buy a house right now or anyone investing in this sector, D.R. Horton is essentially buying their revenue. They're paying for the privilege of selling you a house.
That's a fair way to put it. They explicitly stated that incentives increased throughout the quarter. They exited December with higher incentive levels than they started with. And the biggest lever they are pulling is the mortgage rate buydown.
I saw that. They mentioned keeping their lowest 30-year fixed rate offering at 3.99%.
Think about the math on that for a second. The market rate for a 30-year mortgage right now is hovering around 6%, maybe dipping slightly below on good days. For D.R. Horton to offer a customer a 3.99% rate for the entire life of the loan, they have to pay a massive upfront fee to the lender to buy down that rate.
Just so everyone is clear on the mechanics here, this isn't magic. D.R. Horton is literally writing a check to the mortgage company at the closing table to subsidize the buyer's interest rate.
Exactly. They are prepaying the interest difference. It's technically called paying points on steroids, and that cost comes directly out of D.R. Horton's profit margin. They are effectively taking money out of their own pocket and putting it into the buyer's monthly payment to make the math work.
So to get the borrower from 6% to 3.99%, the builder is eating the difference. That has to be incredibly expensive. Why not just lower the price of the home?
Because lowering the price of the home hurts the appraisal values of the other homes in the neighborhood you just sold. It creates a downward spiral. But if you buy down the rate, the sticker price of the home stays high, protecting the neighborhood value, but the buyer still gets an affordable monthly payment. It's smarter, but it burns cash.
Okay, so they're burning cash to keep volumes up. This leads to the strategic trade-off they kept mentioning. Pace over price.
Pace over price, that is the mantra.
Expand on that for us.
Well, they would rather take a hit on the margin drop from 20% to 19% to keep the volume high and the inventory moving. They are willing to make less money per house just to ensure they keep gaining market share and keep the cash flowing. If they stopped offering the buy down, they'd save the margin, sure, but sales would likely fall off a cliff.
It's a volume game. It reminds me of the Walmart strategy. You crush the margins to kill the competition because the smaller builders, the local guys building 20 homes a year, they can't afford to offer a 3.99% rate. They don't have the balance sheet.
That's the moat. That is the competitive advantage. A small private builder cannot eat that kind of cost. D.R. Horton can. But as an investor, you have to accept that your profit margins are going to be squeezed in the short term while they fight this war.
It sounds like a war of attrition. They are starving out the competition while keeping their own factories running. But let's pivot to the people actually signing these contracts. Who is buying a home in 2026 with rates where they are? Because despite the economic uncertainty, people are clearly signing.
This connects back to what they called the need-based buyer. Management noted that 64% of their mortgage company closings were first-time homebuyers.
That is a huge number. 2/3 of their business is people buying their very first home.
And the average closing price was $365,500.
Which in this market sounds almost like a bargain.
It really is. That is roughly $135,000 lower than the average new home in the United States. And that's the secret sauce. Even in markets where job growth is slowing down, and they specifically got asked about Dallas on the call, where job growth is running at less than 50% of the long-term rate demand, is holding up.
Because if you need a roof, you need a roof.
Exactly. Think about the demographics. People are moving out of their parents' basements, they're getting married, having kids, or they're just tired of rent hikes. If D.R. Horton can get the monthly payment to work using that 3.99% buy down, the buyer will sign. They aren't looking at the macro economy, they're looking at their monthly budget. These aren't discretionary buyers looking for a vacation home. They are need-based buyers.
It's fascinating because it makes D.R. Horton look less like a luxury cyclical stock and more like a consumer staple. Like so they're selling toothpaste or groceries. People have to live somewhere.
To an extent, yes, but a consumer staple with a very, very expensive customer acquisition cost right now.
Let's look at the operational side. We know they're selling homes, but are they building them efficiently? Because I remember during the pandemic, cycle times, the time it takes to build a house from dirt to keys, blew out.
Yeah.
It was taking forever to get windows, appliances, everything.
They've clawed that back. Construction time decreased by 2 weeks compared to a year ago. That might not sound like much, but when you're building tens of thousands of homes, shaving 2 weeks off every build is huge for capital efficiency. It means you get paid 2 weeks faster. It means your loans are outstanding for 2 weeks less.
And what about inventory levels? Are they sitting on too many unsold homes? That's usually the death knell for a builder.
They ended with 30,400 homes in inventory, about 20,000 of which were unsold. But interestingly, their spec count homes started without a specific buyer lined up as down. Because they are building faster, they don't need to hold as much capital in the ground. They can turn the inventory quicker.
Which leads us to the balance sheet. I feel like we say this every time we look at DHI, but the balance sheet is just, it's a fortress.
It really is. Debt to capital is extremely low at 18.8%. They have virtually no leverage stress. And because of that, they can return cash to shareholders even while margins are compressing. They plan to buy back about $2.5 billion in stock this fiscal year and pay out another $500 million in dividends.
That's a shareholder yield that's hard to ignore. Even if the stock is down today, they're buying it back cheaper. And you mentioned their return on assets, ROA, earlier in our prep. It's impressive.
It's in the top 20% of the entire S&P 500 over the last 3, 5, and 10 years. That is a testament to their asset-light model. Remember, they try to control land via options contracts rather than buying it all outright. It keeps the balance sheet nimble so they don't get stuck holding the bag if the market turns.
Before we move on, I want to touch on the supply chain. Any red flags there? We hear a lot about tariffs, labor shortages, materials costs.
Surprisingly quiet. Management said the land market is patient, no distress selling, but no huge spikes in cost. Materials are stable. They explicitly said they haven't seen any impact from tariffs yet. And regarding labor, they made a great point about relationships.
Who's that?
They've been paying their bills on time for 30 years. When labor is tight, the trades, the plumbers, the electricians, they go to the D.R. Horton job site first because they know the check clears.
Consistency creates priority.
It does. And in construction, priority equals speed and speed equals money.
Okay, so let's summarize the landscape before we get to the fun part. We have a company that is moving massive volume, capturing the first-time home buyer and running a super efficient ship. But this T, they're paying through the nose to buy down interest rates, which is crushing their gross margins in the short term, leading to this guidance shock.
That's the setup. The market is spooked by the sub 20% margin guide. But the long-term thesis is that they're consolidating market share while everyone else retreats.
Which brings us to our favorite segment of the deep dive.
The This Is Not Financial Advice segment. Exactly. Disclaimer time. We are just two voices on a deep dive. This is for entertainment purposes only. Do not trade based on what we say. Do your own diligence. But if we were sitting on an investment committee pitching a wild high-risk trade based on this earnings call, what would it be?
I think you have to play the specific mechanic that is driving the stock down. You have to play the rate buy-down dynamic.
I call this trade the 3.99% mean reversion straddle.
Ooh, fancy name. Walk me through it.
Okay, the thesis is simple. D.R. Horton stock is getting hammered because of the cost of the 3.99% mortgage offer. That is the anchor dragging down the P&L. So we have two scenarios.
Scenario A.
Scenario A, market rates. The 10-year Treasury yield dropped naturally this spring. Let's say the 10-year goes to 3.5% or mortgage rates hit 5%. Suddenly, D.R. Horton doesn't have to subsidize the rate as heavily. Their cost of sales plummets.
And their margins would instantly snap back from that 19% guide up to 21% or 22%.
Exactly. And because they already have the volume locked in, remember the demand is there, the stock would rip to new highs. It would be a massive earnings beat in Q3 or Q4. Okay, that makes sense. But what about scenario B? Rates stay high. Sticky inflation, 6% or 7% mortgages forever.
Then D.R. Horton uses that fortress balance sheet to bleed out the competition. The private builders go bust because they can't offer 3.99%. DHI gains massive market share. It's a war of attrition, and DHI is the tank. Eventually, once the competition is dead, they raise prices.
So how do you structure the trade?
You go long DHI using LIPS long-term equity anticipation securities. You want deep out-of-the-money call options for like January 2027. You're betting on the margin expansion event. You are giving yourself time for the thesis to play out.
Okay, that covers the upside. But that's risky. If rates spike to 8%, housing freezes, how do you hedge it?
You hedge it by shorting the pure play land developers, companies like Forestar.
Now hold on, DHI owns a majority of Forestar. That seems counterintuitive. Why short the subsidiary?
It does sound crazy, but hear me out on the logic. If DHI is squeezing their own margins to keep prices low for the consumer, they're going to squeeze their suppliers too. They're going to push back on land prices. If builders are prioritizing pace over price, land values stagnate.
I see. So the land developers get squeezed first.
Exactly. If the builder's hurting on margin, they aren't going to overpay for dirt. So you're long the builder who controls the consumer relationship and short the dirt that is getting commoditized.
It's a bet on the Walmartization of housing. You're betting that DHI becomes the ruthless cost leader that destroys margin for everyone else to win the war.
Exactly. They crush margins to kill competition, then raise prices later. It's the Amazon playbook applied to shingles and drywall.
It is outrageous, but I have to admit, it is plausible. The Q2 margin guide down this 19% number that everyone is freaking out about today is just the pain phase of that strategy.
It's the max pain moment. And usually in the stock market, you want to buy max pain.
It definitely highlights the pivotal moment the company is in. They are betting the farm literally on their ability to outlast the rate cycle.
So bringing it all back home, what is the one thing you want the listener to take away from this D.R. Horton deep dive?
The demand is there, but the cost to acquire that demand is rising. If you are watching this stock or if you are looking to buy a home, you are really watching the 10-year Treasury yield. That yield is the proxy for D.R. Horton's profit margin right now. If yields fall, DHI wins big. If yields rise, DHI fights a long war of attrition.
And in the meantime, they're going to sell 88,000 homes to people who just need a place to live.
And buy back $2.5 billion of their own stock while they do it.
Not a bad position to be in. All right, that's a wrap on D.R. Horton. We'll be watching that 19% margin line like a hawk next quarter.
Absolutely.
Thanks for tuning into the deep dive. Remember, do your homework, watch the rates, and we'll catch you next time.
See you then.